Okay, does somebody want to jump out and tell me what an accounts receivable is?
That's an asset,
Yes, it is. Thank you, Bill.
and it's on the balance sheet.
Right. And what does it actually represent?
Current assets.
Yeah. And how did they come about? Like how, if you're a company, how do you end up with an account receivable?
Well, basically, it's if someone pays on credit or if they basically owe you money.
Yeah, exactly.
Receivable.
Yeah. So if you've sold somebody an item or provided a service and they didn't have to pay cash on the day, you've extended credit to them, then you've ended up with an accounts receivable. Thanks very much, Bill. Okay, I'm just going to jump over depreciation and discuss it more in question 3. But obviously it's an expense because we said it's an expense, and so it goes on the income statement. Does somebody want to jump in with cost of goods sold?
Yeah, sure. Yeah, I do it. Cost of goods sold is, so like if I sold a chair for $20 but it costs like, it's like how much it is to make the chair. So like the wood and the canvas, if it's like a deck chair kind of thing. So
Yeah, exactly. So it's how much it costs you to manufacture.
that's the cost of goods sold, and then it's, yeah.
Sorry, keep going, Ben.
And then
Sorry.
it's on the income statement, and it's on the income statement, and it's an expense.
Fantastic, thank you. So as Ben was saying, it's either the cost of manufacture or the cost that you paid to buy the piece of the chair, for example, that you will then sell on to your customer base. So it's an expense. Thanks very much. Bank overdraft, someone want to jump in with that one?
It's a liability and it's on the balance sheet. It's basically a line of credit from the bank that you have to pay back.
Said beautifully like a retail banker, Rhiannon. Thank you. Oh no, still going. Okay, so let's do our basic balance sheet. Okay, so you've got assets equals liabilities plus equity. Yeah. So assets, things the company owns, and they're either funded by external parties or by the shareholders. So you've got equity. Okay, and then you've got an income statement which is made up of revenue, which is money coming into the company, expenses, money going out of the company. All being well, you're going to have net profit after before tax. Then you're going to have to pay tax, which is obviously a negative. Then you're going to end up with net profit after tax. You may pay dividends. You don't have to. And then whatever's left over is retained earnings or retained profit, and that will supplement your equity. Can you see that okay on the whiteboard? No? Okay, I'll stop sharing for a second and then it's probably more obvious. Can you see the whiteboard now?
Yeah, it's good.
Yeah, okay. So you've got to remember this relationship. Assets equals liabilities plus equity. Revenue minus expenses, net profit before tax, minus tax gets us net profit after tax. Dividends are optional. Whatever's left over comes up here with equity. So equity is made up of share capital, and if the company is profitable and they don't pay it all out as dividends, then it will be supplemented with retained earnings. Okay. Go back to here. All right, so that's where that one goes. Someone want to jump in with accounts payable?
Yeah, well, accounts payable is pretty like similar to accounts receivable. It's just basically the like any money your business owes to like suppliers and stuff.
Exactly, thanks. So therefore it turns up where?
Oh, it goes on the balance sheet, and it's a liability.
Fantastic, thanks. So Rainier, so it's exactly, as you said, exactly opposite to accounts receivable. It's when somebody extends credit to you. So you have an invoice that you'll have to meet under whatever the time frame they allow you to pay. The next item is stock. Now, sometimes students confuse this thinking we're talking like the American version of shares, but what we mean here is inventory. Okay, so where would inventory turn up on the balance on the balance sheet? How's that for a clue?
asset.
Yeah. So this is inventory that you've either manufactured or you purchased with the view to selling to your clients and turning into cash. Thank you very much. Anyone know anything about provisions? You may not have touched on it yet in accounting. Okay, so accounts payable is nice and straightforward. You've got an invoice, you know how much you owe and how many days you've got until you pay it. If you owe the bank money, it's very clear to you how much you owe and how long you've got to pay that back, all right? So they're very rock solid liability kind of numbers. Provisions come about because we know at some point we're going to have to pay some money towards these events, but we're not sure exactly how much or when. So if you're a manufacturing company, then maybe 5% of your goods are returned under warranties because they're faulty, right? And the longer you're in the job of making these canvas chairs that Ben was talking about before, then the better you are at estimating the likely return of those goods, okay? Especially if you keep making them in the same way, right? If you don't apply new technology or something. But every company that has full-time employees has provisions because everybody is entitled to holiday leave, sick leave, and long service leave. But you don't know, obviously, if you had 50 people, you don't know when they're going to get sick, when they're going to take their holiday, and are they going to stay with you long enough to claim their long service leave. So you make your best estimate as to what that will be, you know, and some of it will be in the next 12 months, obviously holiday leave and sick leave, and some of it will be in the future because you have to work for the company for 10 years to claim your long service leave. So rather than waiting until those events happen and putting them in your income statement as an expense, you're flagging it as a liability. And as I said, again, the longer you've got your same staff and the longer you've been in the business, the better you will be at estimating those. Okay, so they're liabilities from the balance sheet. Last one, brand names. Anyone want to hazard what that is?
I guess the non-current asset on the balance sheet.
That's right. It's a intangible asset. Thank you very much. And you can only have those on your balance sheet if you acquired the company that owned the brand. So if you managed to go and buy Google, you could put the value of Google brand names on your balance sheet, but Google cannot have the value of that brand name on its balance sheet. So you have to separately acquire it under the accounting rules. The dividend paid one's a bit of a cheeky one because in actual fact, it's none of the above. Dividends are not an expense. They're an optional payment that management can make if they've had a profitable year and they don't need the cash to further develop the company. Okay, so it's none of the above. I'm going to jump over question 2 because that's just really putting a balance sheet together and I'm mindful of the time. But do have a look at it. If you haven't already done it for homework, go and have a look at that yourself. Make sure that you can construct it. Okay, so question 3, I sort of flagged this a bit early on. So what is depreciation? Depreciation is it's an important expense. So every other expense in this category, your wages, electricity, interest, your leasing, all those sorts of things are cash expenses. You must pay them, right? You've got to pay your employees, you've got to pay the bank, all that sort of thing. They're cash expenses. Depreciation is a non-cash expense in that, let's say it was $2,000 a year. You're not physically handing out $2,000 a year, but it is still important because it is an acceptable tax deduction, then its existence on the income statement means that your net profit is reduced by the amount of that depreciation. And if your profit is reduced, then your tax payment is also reduced. So even though physically it's not a cash expense, it is important because of the impact it has on your tax. Where it does turn up, of course, is that, get rid of this for a second. So if we bought a car for $10,000, then obviously we've got an asset on our balance sheet. And in this subject, we always just use straight line depreciation. So we keep things easy. So if it's got a useful life of 5 years, that means that each year we're going to have depreciation of $2,000, right? So that's going to be a depreciation expense of $2,000, but it's also on the balance sheet going to have this accumulated depreciation of $2,000. So after 1 year, our car is only worth $8,000. After 2 years, it'll have $4,000 of accumulated depreciation. So it's only going to be worth $6,000 on our balance sheet. So that way we recognize that the value of the car over time is reducing, because if we didn't have depreciation, we'd still have this car sitting on our balance sheet at $10,000 20 years from now. Okay, and obviously the car isn't worth the same amount 20 years after we purchase it. So we need to recognize that we're using up the value over time. We allocate that across its useful life. Okay. So this is an example, and this sort of thing comes up in the assignment way down the track when we get to capital budgeting. So it is relevant. It's just, we're kind of just throwing in lots of different ideas in this preliminary class, but we'll expand on them a lot when we come to each week's work. So if you bought a piece of machinery for $150,000 and it has a 15-year useful life, then obviously that's $10,000 per annum. So after 6 years, you've got an asset that started at $150,000. It's had $10,000 a year over 6 years. It's now worth only $90,000. Okay, so the maths is as simple as that. You just work out the annual depreciation, work out how many years of depreciation you've had, and the book value or the written down value is now $90,000 after depreciation. Okay? And then following on from there, after 8 years, right, bought it for $150,000, 8 years of depreciation, it's worth $70,000. If you sold it for $65,750, then obviously you've lost $4,250. Right. Let me know if I'm going a bit too fast, but these answers are all on the system, so I'm going through them reasonably quickly. Okay, working capital and net working capital. So this is just looking at what the firm's current assets and current liabilities are. So current assets are those which will be turned into cash within the next 12 months, and current liabilities are things that you have to pay in the next 12 months. So given that scenario, obviously you want the current assets to be greater than the current liabilities, because if you have to pay all the current liabilities, you only have current assets to pay them off with. So in terms of managing your company, that should be a positive number. If it's not, you're going to find yourself in trouble. All right. And then the next question just asks us to work through this. So if you remember the relationship to assets equals liabilities plus equity, and assets can be current and non-current, and liabilities can be current and non-current. Not sure if you can see that. All right. If we give you a series of numbers, you should be able to work out the net working capital. So you see in the question, we've given you equity and assets. So if you've got assets and equity, then obviously you can work out liabilities. Then we gave you non-current liabilities. So if you've got total liabilities and non-current liabilities, you can work out current liabilities. And we gave you current assets, and you've already worked out current liabilities. Then you can pull all that together for your net working capital. Okay, so total assets, we've given you minus total equity. So there's your liabilities of 21.7. 21.7 minus non-current liabilities of 15.6 gives you current liabilities of 6.1. And therefore current assets of 5.6 minus current liabilities of 6.1 means that you're in trouble because you've got a negative working capital of 0.5 million. All right, so you're $500,000 short of the money you need to pay all your debts in the next 12 months. Okay, earnings per share, we'll talk about this in the last class of the semester, so it's a long way before we start talking about this again, but earnings per share is often written in the financial reporting when they say, you know, this company has just finished its annual year, the financial year, they've had sales of this, they've got EBIT of that, or net profit of this, and then they'll boil it down to an earnings per share. And it makes it much easier to compare the performance of companies across their peers. Because if you've got companies of totally different scale, you can't compare their revenues because they're obviously, you know, a long way apart. But if you boil it down to earnings per share, it makes it a much more comparable exercise. So the formula is EBIT, which is earnings before interest and tax. And then you take away the interest and take away the tax. So you basically boil it down to net profit after tax and divide it by the number of shares, and you'll get the earnings per share. Okay. So again, as I said, the maths is not hard. This is just to make sure you understand how to plug the numbers into the formulas. Tax deduction, I pretty much touched on that. So anything that is allowable under the ATO, which will enable you to reduce your profit and therefore reduce your tax. So a company can incur many other expenses, but they're not all allowed under the tax. So if the company wants to be generous and take all its staff to lunch every Friday, that's very nice, but the ATO is not going to allow that as a tax deduction. All right, so you can have expenses that you can fund as a company, but you can't claim them all. In the same way, there was a classic example, I think it was last year, the ATO put out silliest requests for tax deductions in the last 12 months, and some couple wanted to see whether their wedding was tax deductible. Okay, so, you know, you can get married if you want to, unless you're in Victoria right now, sadly, but you can't claim that as a tax deduction. All right, so you can spend money, but it's not all going to be allowable as a tax deduction. And this last one relates to annuities, and we'll do this in about week 3. So an annuity is where you pay or receive the same amount of money for a fixed number of periods. So in this example, you're paying $12,000 a year, every year for 5 years. If you can earn 4% per annum on that money, what is it worth in 5 years' time? Is basically what it boils down to. Now, we don't use these tables. We have a formula for that, but you may have used these tables when you were at high school. So just as a refresher, you're looking at 4% and 5 years. So the factor is 5.4163. And the contribution is $12,000 per annum. So 12,000 times that factor says that it is the same as $12,000 every year for 5 years at 4% is the same as a one-off lump payment in 5 years' time of $64,995.60. Right? Now, as I said, we don't do that. We use a formula. And so here's our formula. It's saying, what is the future value of this payment if the interest is whatever it is and so many payments? So $12,000 payment, 4% interest, 5 payments. So you can see the same factor comes through, except here it's in 8 decimal places rather than 4. So this answer will be slightly more accurate, but very close to how you would have got it from the tables. Okay, but we're going to spend the whole day talking about annuities. So just so long as you're comfortable enough with the maths of this, just that's all you need to do at this stage. All right, so I want to spend, the rest of the time doing today's questions. So we've got 6 multiple choice questions to start with. And let me just check that I'm sharing screens properly. Okay, there we are. So can everybody jump in and just do the first 3, just write your answers on a scrap paper. And when you finish those 3, can you just do the tick the participant box for me so I know where everybody's up to, please. And then we'll discuss those as a group. So just go through those at your pace, and as soon as you've done the 3, just tick the box for me, please. Sorry.
Sorry, I've just got a question.
Yeah.
On UTS Online, the document under tutorials, like the homework questions, and tutorial 1, it's like 7 long answer questions, and I completed those before, but I don't know where the short, like the multiple choice ones are.
The one that I've got in front of me.
Yeah.
Yeah. So that I think probably will go up after the last class this week.
So are we going to go through that as well?
So that's what we're going to go through now. So from here on in, the homework will have the question and answers for you to practice between the lecture and seeing me next week. And then I will introduce this in-class question.
Right.
And not for this week's, because this is just sort of theory questions, but where they're practical questions and they have a dollar answer, on the bottom of the page, they'll just have that dollar answer, and that will get posted up. Like we run classes, I think I'm doing the last class, it finishes at 7:30 tonight. So somewhere later tonight or tomorrow, the answers would go up online. Not for today's because it's all theory. So, but anything that's just a purely practical question, then there'll just be the answer to it. That makes sense?
Because the one that I'm talking about, it says like question 1's like, can a profitable firm experience cash flow problems? And it's like, I'm assuming expect like a long answer question, like answer.
I think I'm just going to jump out and have a look, but I think you're referring to the homework questions.
I
Just
think
give
so,
me two.
yes. I thought that was what we had to do before.
You do, but those would have the answers to them, Sarah.
Right. Okay.
So you should find, right, so we got shoot, and then it says homework questions. So you got tutorial 1 to 10, and that is kind of, yeah, so that's that one. Now you see at the bottom of that page, it doesn't have any answers to it because that's pure questions. And then underneath that, it has solutions. And then you can see tutorial 1 has got the answers for that there.
Right, okay. Thank
With me
you.
now? That's all right. Takes a while to get the hang because each one has a slightly different, each subject kind of has a different setup. So yeah, so that's the idea. You do those ones ahead of class. And then if you've got any problems with them, obviously ask as soon as you get into class. So we're not, I'm not leaving anyone behind. So we've got about half people. Don't forget to tick when you finish so I know where we're up to. It's like watching sunset looking into your house, Rhiannon. I can see that you've gone from a sunny background view to, oh, there you go, the day's over.
Yeah, normally you can see heaps more, but it's so rainy that it's just trees out there.
Yeah, that's a very lovely window. I'm having house envy. I'm sitting in the basement of my place. Okay, so still about 10 people who haven't said they've finished the question. How are we getting on? Okay, I think pretty much everyone's all right with that. I hope I'm not rushing anybody. So it always takes a while, the first couple of weeks, until we get the hang of each other. Who wants to jump out and tell me the answer to question 1?
The
Sorry, I didn't hear you.
last
Sis.
one. Last one.
A maximization of profits. Okay.
Yes.
I
Does
said
anyone
B.
have a different? Tom, what did you say?
I said B.
Okay. Do you want to tell me why it's B and not D?
Well, I wrote that it was the what was it? It was just to ensure you want to profit maximize is wrong because it focuses on profit, which is not exactly cash.
Well, that's
And-
part of the problem with it.
And
yeah.
you want to maximize the owner's wealth. So like, I don't really know how to explain it. I just read it that it was correct.
Okay. Anyone else want to jump? Okay. So maybe it's almost easier to explain why it's not profits. Or okay, let's start at the beginning. Why is it not minimization of risk? What's wrong with doing that? If we minimize risk, what else are we doing? Sorry, Dee, what were you gonna say?
Because if we minimize our risk, we will receive a minimized return.
Exactly. So if we don't take any risk, we won't earn any return. And the management of the company is supposed to be adding value to the company. So we don't want them to take crazy risk, but they've got to take some risk. Okay. So if we look at C and D are kind of tied in together. So if you think about the accounting relationship, so revenue minus expenses equals profit. So if we pursue profit or we try and minimize expenses, what can be some of the problems that's associated with that?
You can manipulate your profits to be higher over one sort of quarter and then less over the other ways through your choice of accounting. So the shareholder wealth is more like stable. The profit one's a bit sort of murky.
Yeah, that's very good. So profit, really, it's just an accounting exercise is what you're really saying. So under the accounting rules, we say this is revenue, this is expenses, bingo, you've got profit. So you can play around with your numbers and make the profit look good, okay? And just think about like in terms of minimizing costs. Now, there are certain costs you cannot avoid. You cannot not pay interest or the bank will take the company or they'll try and sell off your assets to recover their money. You can't not pay your electricity because they'll turn it off. You cannot not pay your water because they'll just turn it off, right? But think of a couple of situations that you could try and minimize some very important costs in the company that won't have an immediate shock to the company, but in the longer term are doing a big damage to the company. Anyone suggest something that might, if you get what I'm driving at there?
Paying your staff properly.
Exactly. So, I mean, obviously you've got to pay them in accordance to, whatever they've signed on to their contracts or their award wages and stuff. But obviously if you're, can provide some kind of a bonus or a good working environment, some kind of an incentive, then your staff will be happy, they'll be more productive, the company will benefit from them. If you withhold all of that, then obviously the best people will leave, and then that's just going to drive down the value of the company in the future. That's a really good example. So can you think of a few more things that are really important, not going to have an immediate impact, but over the long term, we're going to have a negative impact on the company. Excuse me. How do we know about companies?
Advertising.
Advertising, yeah, exactly. So if the company's product is already doing very well, that's fine for the moment. It might carry through for a whole year. But, out of sight, out of mind, somebody will start to forget about you, and then somebody else will take the place, and then your market share will be impacted, and then you find that you're no longer nearly as profitable and well known as you were before. So that's certainly another big consideration. Why do you buy things like Apple products? And obviously it's a product that's got a good reputation, but why is Apple so successful year after year after year? Has everybody gone to sleep on me?
Wouldn't it be like its brand name for Apple? And like they also value proposition to consumers and stuff, like offering a fast mobile phone that you can use to connect to people and stuff.
Okay, so why is it so fast and all this? What have they done to make it do that? What have they invested in? You're on the right track.
But they've invested in like their own processors and like their own software, like their iOS instead of like Android or something.
Yeah, because a lot of their staff are working on R&D and product development and that sort of thing, aren't they? So, and that's an expensive process. So if you just cut that back, all the R&D, or, you know, having high-end employees who've got those sort of skills, then everybody is currently buying whatever the latest iPhone is, which is fine for now, but that's not going to drive revenue in 2 years' time, because they don't want you to stick with the current one. They want to keep innovating so that you keep wanting to buy the next one along the line, don't you? Does that make sense? So thanks for that, Raina. What was the other big one I was thinking of? Just, okay, so if you think of a really high quality product, right, you naturally pay a premium because it is a high quality product. What could they do to reduce the cost of that, to increase their profit?
Use like lower quality, cheaper materials.
Exactly, yeah, because it'll take a while before the reputation is tarnished, because on the outside it might still look like the same product. But if they use some kind of a cheaper input, then obviously that's going to have some knock-on effect to the quality, and then the reputation is going to be, you know, reduced. And it takes a lot to get your reputation back again. So fantastic input from everybody there. So you can see why it's not A, C, or D. And so collectively, the best thing is really to maximize shareholder wealth, because that benefits obviously the people who are providing the funds, and it drives the company into strong future growth and all the rest of it. Okay, question 2, the risk and return function. So risk is on the horizontal, return is on the vertical. What sort of relationship do we think there is?
Upward sloping.
Upward, thanks very much, Adib. It is upward sloping, because if you take on more risk, you should be expecting to be rewarded with a greater return. Fantastic, thank you. Question 3, somebody want to jump in? Capital budgeting is an example of?
It's investment decision.
It is an investment decision. Thank you very much, Mingwei. Financing decision is obviously how you're going to fund the company, whether it's debt or equity or combination of that. Dividend is also a financing decision, because if you have shareholders, are you going to pay them a dividend or not? Working capital is just that composition of current assets and current liabilities we looked at before. So investment decision is the only answer there. All right, so we've got 3 more multiple choice questions, and then we'll move into some short answer ones. So if we could do what we did before, just when you've done your 3, just tick the participants for me. Sorry, Josh, I didn't see your comment before. I'm sort of working on everybody using their microphone as much as possible. But you're right on your answer. Thank you. Okay, don't forget to tick when you're done. Okay, does anybody, oh, sorry. Does anyone want to jump in with the answer to question 4?
I put in D.
D, limited liability. Thanks, Adib. It is, absolutely. Profits are obviously taxed at the corporate tax rate, and neither the shareholders or the directors are liable for paying the company's debts. That's the whole point of limited liability. So shareholders can only lose their full investment in the shares, but nothing more. And directors are accountable for many things, but they're not liable for repaying any borrowed funds. Thank you very much. In a primary market transaction, what do we think the answer is to question 5?
It's C.
C.
Yes.
So the ASX is actually the stock exchange. It's the company. It's actually now a listed company. But I'm sorry, that's not the right answer. Sorry.
I said
someone-
D.
D.
D, yes, D. So you do have situations where the company does buy back the shares from investors. So sometimes if the company's been around for many, many years and the share capital just keeps growing and growing, you get a situation where they'll often buy the shares back. Sort of, it's the same as like having an extra dividend. So the investors sell back their shares to the company and then they receive the cash from that. Then the second one is a secondary transaction. So if I own some shares and I sell them back to through the stock exchange, then someone else is going to buy those shares. So that is a secondary transaction. The ASX is the actual securities exchange or the stock exchange. So it's not that one, but D is the right answer. So thank you, whoever jumped in with that one. And the last one, which of the following is an example of an investment decision?
Is it B?
B, yes, it is. All the others, A, C, and D, are all financing decisions. So having more equity or less debt or paying dividends are all finance decisions. So the only one that's an investment decision is the excavator idea. Okay, fantastic. So now we're just going to do one question at a time. So just, it seems very night-like. Everyone's rooms are just getting slowly darker and darker. Just have a look at question 7 and then we'll just have a chat with each of these questions. So when you buy shares in a company that is listed on the ASX, the funds are passed to the company. So that's the same as me saying today, I've got a spare $10,000. I'm going to go and buy some shares in Westpac. Okay. If I was to buy some shares in Westpac today, would the money go to Westpac or would it go to some other party?
False.
Yes, Bill. So who does the money go to?
I just know that it doesn't go to the company, but I really don't know how to like abbreviate more on that.
Someone else want to jump in?
Yeah, it goes to the previous owner of the share that
Exactly.
bought it.
Yeah. So if Rainer happened to own $10,000 worth of Westpac shares today and decided to sell them, and we're the only 2 people in the world, then he would put in an order through his broker to say, I want to sell Westpac, and I'd put in an order through my broker to say, I want to buy some Westpac, and however much I pay is going to flow through to Rainer, not to the company. Only if Westpac were going to issue some new shares would the money go to Westpac. But if there are already existing shares trading on the exchange, then the shares remain, Westpac shares, but just the ownership changes hands. Westpac wouldn't even be aware of the fact that Rainer and I have entered into this contract. All right, thanks for that. Question 8, can a profitable firm have a negative cash flow? So going back to my previous little exercise here. So revenue minus expenses equals profit. So revenue is money in, so it's a positive. Expenses is money going out, and all being well, you'll end up with a profit, which is a positive event, okay? So how could it be that we end up with negative cash flow?
If a majority of your revenue is accrued, then you won't be having cash flowing in, but you could be spending a lot. So you'd have a lot of outflow, and then it'd be negative.
Okay, so Adib, fantastic. So what you're saying is if all my revenue or a majority of my revenue is not cash based, but is based on credit, then that money is not coming in. It might ultimately come in, but it's not coming in fast enough to keep up with the expenses where the money's going out. So this equation is an accounting thing saying, well, all of my sales, cash and credit, are allowed to be recorded once I've provided the good or service under the accounting standards, and expenses, you know, I can do those under the accounting. And in theory, on paper, I've got a profit. But as Adeep says, if most of that revenue is generated on credit terms and my clients are very slow to pay that money in, then that's not coming in. Unless I've got very generous credit terms for my expenses, then the money is going out and I end up in a negative cash flow position. All right. And that's a very dangerous thing to find yourself in. This is nice, but this is far more important, that I've actually cash flow positive. Does that make sense to everybody? Thanks for that, Adeep.
Yeah.
Sorry?
I'm just saying thank you.
Oh. What do we think is more important, the investment decision or the financing decision?
Probably the investment.
It is, yes. Anyone want back Rhiannon up as to say why it's the most important? Okay, imagine this. There's 22 of us in this room at the moment. If we all brought $1 million into the room together, we're sitting on a pile of $22 million worth of cash. If we don't know what to do with it, it's not going to end up being productive, is it? Whereas if we all met and decided what we wanted to do as a company, and we thought, okay, we're going to manufacture whatever, and we're either going to go and lease the premises, or we're going to buy a factory, and then we're going to buy the equipment that we have to do to make all this happen. It's that equipment that, you know, all of the things we think about, all the assets we're going to buy with that cash that are going to generate the revenues and the cash flows of the company. So we need to have the idea, we need to make those decisions about buying assets to generate the revenue. And secondary to that is, now how are we going to pay for it? Because cash on its own is not productive. Does that make sense? Right. So the investment decision is the primary consideration there. Then we've only got a few more questions to go. So the question 10 is saying, compare Facebook's market value with its book value. Now, before I ask you to answer the question, just to give you a bit of background on what that actually means. I'll just stop sharing for a second so you can actually see the board. All right. So market value just means the number of shares in a company times their share price. Okay. Book value is just the equity on the balance sheet, which of course is equity just equals assets minus liabilities. All right. So there's generally quite a difference between the market value and the book value. If this is greater than that, that's a good thing. If the market value is less than the book value, that is not a good thing. All right. So if you want to look at an example where it is the other way around to Facebook, Myers, the department store, currently has a book value greater than its market value. So that's not a good position to be in. And I can talk a bit more about that after we've answered the question. But let's go and have a look at Facebook. Hang on a minute, where have I put it? So if you look up Yahoo Finance and you put in FB, which is Facebook's code, you can see a huge amount of information about them. So let's just come back to the summary page. Okay, so here's Facebook. So the last time Facebook traded, which would have been yesterday, it was trading at US dollars $265 a share. It went up $16.16 on the previous day, and that's a 6.5% increase that day. All right. Now you can see over here on the graph, this is how it traded yesterday. It opened the day at $249 and it finished up at $265. Right? And it's a great website. You can go back and you can look at it across its life. So since it listed in May 12, it started life at about $27 a share, and now it's about 10 times that at $265. Okay, so if you'd had some money, or your parents or grandparents had bought you those when you were born, you'd be all very wealthy people by now. And it tells you things like what was the range, the high and low of the trading range yesterday, and what it's done in the last year. So interestingly, if you look at the last year, this is where every price fell off the cliff, because in Australia, the 20th of February, that was our all-time high. And then when we started to realize the impact of COVID, the share market dropped by 30%. So you can see that's happened here, even to the biggest companies like Facebook. So it dropped massively from there, and then it's recovered and gone beyond where it was before. So the 52-week range has been from $137 a share all the way back up to about where it's trading today. On average, it trades about 24 million shares a day. So this is what we call a very liquid share. Okay, if you buy in and out of Facebook, there are plenty of people willing to buy and plenty of people willing to sell on any given day. So it's very liquid. So the number we're after is this one here, market capitalization. So at the moment, Facebook's market capitalization is about $755 billion US. Okay. So if you wanted to buy all the shares in Facebook today, it would cost you $755 billion US. All right. Now we want to compare that to its book value. So if you see this tab here, it's got their financial statements, or the abridged version. So income statement and then balance sheet. So if we scroll down, we see here that it's got a pretty basic balance sheet. It's got a lot of cash. So between the cash and other things that they've invested in, like shares or bonds or that sort of thing, they've got about $55 billion worth of cash. They've only got $133 billion worth of assets. So, you know, getting on to, I don't know, whatever that is, more than a third, probably 40% of the balance sheet is made up of just cash, because they keep just making so much money, they're just sitting on a pile of cash. And then they've got a bit of property, plants and equipment, and a little bit of goodwill, and that's about it, right? They have almost no debt because they don't need to have any debt because they've got so much cash, they don't need to borrow any money, right? And so the net result of that is that they've got equity of about $101 billion, right? So there's about 7 times, the market cap's about 7 times the book value of the company, all right? So can we think why this is so much higher than that? What's pushing this number so high? There's sort of 2 questions. What's making this so high, and what is limiting this to be so low? There's sort of 2 factors at play there.
What's pushing it so high is that the investors think that it's going to grow more, so they want to profit off of that.
Yeah. So there's a positive sentiment by the market that this is a company that's going to drive through to the future and it's going to keep being profitable. Exactly. Sorry, Adib, were you going to say something else?
No, I'm not sure of the second part of the answer.
Okay, but you can, everyone see how that's happening. So the investing public is saying that if you look at how the company has gone, it's got a worldwide exposure, it's got a massive market share, it's got a great following, it's got a lot of cash, so if it wants to buy up any competitors, it can. Probably the only thing that's working a bit against it is that Facebook and another couple of the big companies, Microsoft and who was for the other 2, were called
Amazon.
before the Amazon, thank you, and there was a 4th,
Google?
Was it? Yeah, I think it was Google. They were all hauled before the Senate in the States the other day because they're being accused of having too much power. And it's pretty hard to argue that they haven't, because they have so much cash. Anyone who even comes up with a bright idea, they can just buy them. And they can buy them for any price. It's worth it for them just to buy them and take them out of the competition. So you know, that's probably the only thing that might restrain their growth in the future years, is that people might start to push back against this sort of any anti-competitive behavior. So that's a very positive sentiment there. Thanks for that, Adi. If you think about it, this was the clue in it, right? All you can see on their balance sheet, because if you think about it, it's assets minus liabilities gives equity. So all you can see on this balance sheet is a chunk of cash, right? A bit in receivables, a bit of property, plants and equipment, goodwill, and that's it. All right. What is missing, because it's not allowed under the accounting standards, there's nothing in that balance sheet, that set of assets, to recognize the value of that brand. So all of the intangible value of this company is reflected in the market capitalization, because the market puts value on that. But because accounting standards are very conservative, they're not allowed to put the value of their brand, their goodwill, on their balance sheet. If somebody bought the company, and let's say it's, you know, it's worth 755 billion. So if somebody came along and paid 800 billion for the company, then they would be able to recognize the goodwill value and the brand name and all the value. That's why they've paid so much money to buy all of Facebook. But under the accounting terms, you cannot recognize your own intangible value. So that's why the asset number is so limited, because it's limited to, you know, like physical assets, cash, property, plant and equipment, a little bit of intangible, but that's pretty much all that they're allowed. So the net effect is the equity has stayed relatively low. It's really kind of growing only by nature of it's profitable, and so the cash keeps building up, but it's not growing at the same sort of rate as people are putting into the valuation there. Does that make sense to everybody? Hopefully. Okay. So if you ever see a company's balance sheet and they've got goodwill, that's because they've bought another company in the past, and that's the premium they've paid for that company. It's nothing to do with their own intangible value as recognized by the market. So any company that is still under the original ownership, that has not been acquired, you know, so Google, Coca-Cola, all of those big companies, none of that value that's built up through reputation and all the rest of it over time is showed in their balance sheet. Okay, so back to question 11. Am I still sharing properly? Hopefully. We've touched on this a couple of times already today. So what is one reason that a company's revenue might be higher than its cash sales? Revenue's made of, sorry?
Receivables?
Yes, so you've got cash sales and you've got credit sales. So obviously the combination of the two is the revenue. Okay, I'm just realizing, as usual, I'm not running too well to time. So I've got about 10 minutes left. So somebody wants to jump in. What is the agency problem?
I'll have a guess. I'm not 100% sure, but is that the conflicts between the owners and the management of a company if they both have different values?
Exactly. Conflicts of interest, exactly. So the shareholders are the owners of the company and they're taking the risk on the company. The management is supposed to be acting in their best interest, but oftentimes other things get in the way of that. So they're obviously looking out for themselves. They would like to pay themselves a large salary, which they're entitled to if they're working hard, but there is a, you know, there is a tipping point at which they're paying themselves too much money. So there is a temptation for them to take conservative risks, because if they take too much risk on and it goes wrong, they will lose their jobs. If it goes right, then most of the benefit will go to the shareholders. So why risk it in the first place? Better just to keep doing the same old job that's working well, rather than trying something new and risky, because as I said, the benefit goes to the shareholders. If it goes wrong, the backlash will be to the management. So, you know, or you don't want them to take on crazy risks because they're getting desperate and they want to make some kind of a bonus up for the year, or you don't want to find that, you know, the shareholders have put money into something what they think is going to be productive and they sideline that money into some other thing. And it can also happen with debt holders. So if the company goes to the bank and says, can I borrow $10 million to build a new factory? And the bank approves it because that is productive use of their money. And then they find out that they take the $10 million and then hand it out to the shareholders as dividends. to keep the shareholders happy, that's not productive use of the money. So anyone who's putting money into the company, be they debt holder or shareholder, can have agency costs. Okay, and that leads us into the last question. So before I ask you to answer the last question, I just want to show you these two examples of some cases that happened in the last few years in Australia. Hopefully you can see that, one about Rio Tinto. So just have a read of that, and then I'll show you the one on the next screen, and that'll might give you some ideas to answer the last question. Have we read that one? Okay, and the second one's a bit shorter, so similar idea. So hopefully everyone's read that one. So I'm just going to stop sharing for a second so you can see the board. So what that meant for, let's just do the Japan Post one. So they had an asset that they bought for $6.5 billion, right? That's Australian dollars. And then that was in 2015. And 2 years later, they realized that, what did they impair it by? It was like 4.9 or something, I think. They realized that they'd overpaid by 4.9 billion. So it was actually only worth about 1.6 billion, right? Now, if the asset drops by 4.9 billion and the liabilities stay the same, the equity also drops by 4.9 billion. So if you're a shareholder in Japan Post or Rio, you have just seen them burn through billions of dollars of your money. Okay, so obviously you're not going to be very happy with that. So try and sort of apply that idea to the last question. Where am I? Sorry, one sec. Okay, so from the bidding company's point of view, think of some of the agency costs that might, you know, what was driving those huge numbers when they went and said, right, I'm going to acquire that company and I'm going to pay that kind of money for it.
It might have seemed profitable in the short term.
Well, you'd hope that they were facing, you know, you'd think they should make a decision based on it being a good fit with their company and that they can recover whatever they pay for the company, they should be able to recover in future cash flows. As otherwise, why would you pay that much money? So that's what should be driving their decision making. But why do you think they've technically overpaid for it? So I've got lots of help coming in from Bill, Rhiannon, and Adib, and there are 20 people in this room who are not saying much of anything. So can we give a bit of support to the other three, please? What would make you overpay for something? Just think of it on a personal level. Sorry, Bill?
Potential for more gains, possibly. That's how I would just see it.
That's what you should be doing. So, but just think on a personal level, if you've got money, right? Like just say you find an item, you know, let's say it's I don't know, something ridiculously overpriced. Let's just say you've found I don't know, an article of clothing, a jacket, a really nice jacket, and it's $10,000. Would you buy it on your current salary? Any of you?
No.
No.
Probably not. Okay. What might make you buy it? What might happen in your life that you suddenly go, yeah, I can pay $10,000. That's not a problem.
Like if they came into a large amount of money suddenly.
Exactly. So if you suddenly woke up one day and you had bucket loads of money, you wouldn't stop and think, well, hang on a minute, is that jacket really worth $10,000? Or is it just, because it's got some particular label and everybody's wearing it and everyone's talking about it now? But if you suddenly woke up, as Rhiannon said, and you'd won the lottery and you got $50 million in your bank account, of course you'd go and buy it, wouldn't you? You wouldn't stop twice to think about whether it's a good fit. Do you even like it? Are you going to use it? Or you just go, I love it. I've got a load of money. I'm going to go and buy it. All right. So sometimes you find companies are sitting on a big pile of cash and they don't really have any other great ideas for it. And the more money you've got, the easier it is to make a decision, isn't it? You just say, okay, well, if I'll have that, I'll have 10 of that, whatever it is. The other thing is it, again, go back to the same scenario. Just imagine we still all had casual work and something costs $100. So generally you go, okay, well, that's so many hours of work. Do I really want to spend the $100? Or, it's Christmas time and your lovely grandparent just gave you $100. It's much easier to spend your grandparents' $100 than it is to spend your own $100, isn't it? Because, let's face it, your grandparent didn't have to stand there for 5 hours on their feet to earn the $100. They've just pulled it out of their bank account and given it to you. So if it's not your money, it's much easier to spend. And it's easier as management to spend the shareholders' money than it is to spend their own money, isn't it? So they're not making that decision based on their own income. They're basing it on, okay, I've got this pile of money that doesn't belong to me. I can sign a check for that. Sorry, Thomas, were you going to say something?
Are you saying like there's no connection to the value of the money? Like they're not worried about what will happen?
Well, I can't see that either of those two parties were very concerned. They just went, well, we've got the money and we're, yes, it fits. I mean, yes, we're buying another mine, or yes, we're buying, Japan Post does deliveries and transport in Japan. So why not buy a company in Australia that does the same sort of thing? But did they crunch through the numbers to see whether they'd ever recover that kind of money from the exercise? Or did they just go, we've got a lot of, or the company's got a lot of money and it's not really going to hurt my bottom line because it's not my money, it's the shareholders' money. So it's easy to overpay for something. Do you see what I'm saying there?
Yeah, thank you.
And what about ego? How does ego come into the story?
Like when Facebook buys their competitors just to show that they can.
Well, yeah, exactly. And it just makes them bigger and bigger and bigger, doesn't it? So I always sort of liken it to, if you're the CEO of if you're a local businessman, you're well known in your neighborhood, you're well respected, the bank knows you, all that sort of thing, right? That's so unhealthy, Rhiannon. I'm so ashamed of you.
Sorry.
It's your house, you can do what you like. In fact, it's your lungs, you can do what you like. So, you're well known locally. Sorry, I'm not supposed to embarrass you, but, I've been doing this 4 classes today. I've got to interact somewhere. But obviously if you're the CEO of a biggish company in a regional town, then you're well known there and all that kind of stuff. If you're the CEO of the biggest company in Australia or the biggest mining company in the world, then everybody knows your name. We all know Mark Zuckerberg runs Facebook, right? Don't we? These guys who are at the top of the pile of these enormous companies are feted worldwide. Every door opens for them. Every bank wants to know them. Everybody except maybe Trump doesn't like social media so much as he used to before, but they're well fated. So ego gets in the way of it. If you could be the CEO of the biggest mining company, then it's good for you, prestigious. The other thing I thought of too as a negative is that what if the management of the bidding company had an undisclosed investment in the target company? So they would personally benefit, very sweet. They would personally benefit if the bidding company bought shares in the target company because they've got a personal investment in that one as well. Okay, so there are all sorts of agency issues that, you might say, that's a well-loved animal.
Sorry, he wanted to come up. He was barking.
Oh, I'm more than happy that we have, I don't care what our students look like, so we can have dogs as well as anybody else. Can anybody think of, from the target point of view, what's an example of an agency issue? So the company that's on the receiving end of the takeover, what could be an agency issue there?
If the management wants the takeover and the owners, the shareholders don't.
Okay, Why? Okay, so why would the management be in favor of the takeover of the shareholders? Where would they stand to gain in a takeover?
Sorry, the other way. If the shareholders want the takeover, but the management doesn't want the takeover.
Okay, that's more likely. Why would the management not likely want the takeover to go ahead?
Job security.
Job security, exactly. Because if the company gets taken over, you can only have one CEO, one CFO, one head of accounting, one head of marketing, one head of production, one head of whatever. Okay, so generally speaking, the target company or the executive management will lose their jobs, and the only people who will retain jobs in the target company are ones where they're adding some value. They've got something that the bidding company has not got. So whether it's the relationship managers with the clients, whether it's some kind of expertise, whatever it might be, they will retain their jobs and everybody else will lose their jobs. Okay. And the only other thing, just to wrap it up because of time, is another idea I came up with, is that the management might roll over quite quickly and say, yes, go with this takeover, when maybe they should negotiate for a better price. They could say, well, look, on paper, we don't mind the idea of the takeover. We can see that the two companies would fit. But I think the price at the moment isn't really up to what, what it might be. So why don't you sweeten the deal a bit better and put the price up a bit? But if they acquiesce too easily and give in on the first bid, they're not acting in the shareholders' best interests either. Okay, so they're all the sorts of ideas there. All right, I'm going to wrap it up because I've got a 6 o'clock. Next week, we're not going to try and jam 2 classes in one, so it won't be as rushed as this. Can everyone please make sure for next week then that we've got Excel on our PCs, that we've printed out the formula sheet for me, and do the homework, check your answers so that you're good to go and do another bunch of questions in class. Okay. Anyone got any quick questions just before I wrap it up? Okay, all right, great. Well, thanks very much for all the contributions today. Nice to meet you all. Next week, it'd be lovely if we could have some more cameras on and then we could meet the rest of us. And have a nice weekend. I think it's going to rain all weekend, but you can always do your FBF homework for want of anything else to do.
Thank you.
Thank you.
Thank you very
Thanks
much.
very much, guys. Good night. Enjoy your evening.